Best Vanguard index funds. So today we're going to go over some of the best index funds you can use to create a diversified investment portfolio that's easy to manage. Now, I like to talk about individual stocks on this channel because that's what I'm personally invested in, but if you don't have the time or are just not interested in researching individual stocks, instead you can invest for a very low cost using index funds. Vanguard arguably has the best lineup with regards to these types of funds, so today I'm going to walk you through the very best ones and show you some simple portfolios that you can create with these funds. If you like investing, making more money, or building wealth, I highly recommend you click the subscribe button and notification bell. All right, let's begin. So if you navigate to Vanguard's website, you can see at the top there's a section called investing. If you go under investment products, you can click on either Vanguard mutual funds or ETFs. So a quick difference between ETFs and mutual funds is that ETFs, or exchange traded funds, trade on the exchanges just like an individual stock during the trading day, but they are a fund that's comprised of many individual stocks, or if it's a bond ETF, many individual bonds. A mutual fund is a fund much the same way as an ETF, but it does not trade on the exchanges. Instead, it's priced at the end of each trading day. For this video, we're going to look at ETFs because some of the mutual funds do have a balance requirement that you need to hit before you're able to invest in the fund. ETFs, as long as you can buy at least one share, there's no other minimum dollar requirements. So when looking at the ETF browsing page, you may be intimidated by the number of ETFs that are available, including bond ETFs and stock ETFs. However, we're just going to be covering the main core positions that you'll likely hold in a very simple index portfolio. So one of the most popular ETFs, and likely the one that'll take up the largest portion of your portfolio if you do index investing, is the Vanguard Total Stock Market ETF, ticker symbol VTI. The Vanguard Total Stock Market ETF basically holds a piece of every publicly traded company in the United States. Its performance matches extremely closely to the S&P 500 index. The main difference is that it does include some small and mid-capitalization stocks, or stocks that are smaller than the largest 500. The ETF currently has a dividend yield of 1.82% and has historically over the past 10 years returned on average about 10.3% per year. Keep in mind we've been in a very strong bull market, so future returns may not be as strong as the past 10 years. One thing to keep in mind is that the index is about 20% financials, which are banks and insurance companies and other financial institutions, and about 20% technology. So it's heavily weighted towards those sectors. Its 10 largest holdings include Apple, Microsoft, Amazon, Alphabet or Google, Facebook, Berkshire Hathaway, JP Morgan Chase, ExxonMobil, Johnson & Johnson, and Bank of America. Now these 10 stocks represent 18% of the total portfolio, so the performance of this fund will be more impacted by any large movements within these 10 stocks. One of the best things about Vanguard index funds, and the Total Stock Market Index Fund in particular, are their extremely low fees. Not only does Vanguard allow commission-free trading of their ETFs, which means you can buy and sell without incurring commission costs, but their expense ratios, or the amount it costs to manage the fund, are also extremely low. The way expense ratios work is that when a fund receives dividends or capital gain income, the fund will take a portion of that income away, and instead of distributing that to you, it'll use that to pay management expense fees. So one way to think of it is the higher the expense ratio on the fund, the less capital gains and dividends you'll be getting from the fund. As you can see with the Vanguard Total Stock Market Index, they have an expense ratio of 0.04% compared to an industry average of almost 1%. Now what that means in actual dollars is if you invested $10,000 over 10 years, on average for an industry fund, you would spend or sacrifice almost $2,000 of dividend gains that you could have had, versus if you invested that with Vanguard, it would only cost you $95. Investment fees are a huge part of what takes away from a portfolio's gains, and is a primary reason why index fund investing has outperformed many active managers over longer periods of time. So in practice, if you wanted to purchase this Vanguard index fund, you could do that by opening a brokerage account with Vanguard directly, or if you already have a Robinhood account, you can just search the ticker symbol for the ETF on Robinhood. In this case, we're looking at VTI, the Vanguard Total Stock Market Index, and then you could just purchase shares directly from your Robinhood account. Now, over recent history, US stocks have outperformed international indices, but some investors may want to have some international exposure within their portfolio, and Vanguard offers several international ETF index funds that can help suit those needs. One of those is the Vanguard Total International Stock ETF, ticker symbol VXUS, which is effectively the complement of the Vanguard Total Stock Market Index, VXUS effectively invests in every publicly traded company outside of the United States. The index is very globally diversified, with about 20% of the portfolio in emerging markets, 42% in Europe, 30% in the Pacific region, around 6.5% in North America, and then the remaining 1% in the rest of the world. The index has over 6,000 stocks, of which the top 10 make about 8% of the portfolio. The fund has an expense ratio of 0.11%, which is very low for an international fund. The next two stocks I'll discuss in tandem because they're closely related. The first is the Vanguard Developed Markets ETF, ticker symbol VEA, and the second is Vanguard's Emerging Market ETF, ticker symbol VWO. VEA invests in the developed markets internationally, so that would include countries in Europe as well as Japan and a few other countries. VWO invests in the stocks of companies located in emerging markets around the world, including China, Brazil, Taiwan, South Africa, and others. These two ETFs are basically the split components of the Vanguard International ETF, but split into the developed and emerging markets. As such, VEA is a much higher weighting on Europe and developed Pacific countries like Japan and South Korea. VWO, on the other hand, has almost an entire weighting on stocks in the countries of emerging markets. VWO is particularly weighted in China, where about 36% of the portfolio is located. The remaining 64% of the portfolio is split among other emerging market countries. But remember, when investing in this fund, it'll be heavily influenced by the performance of the Chinese stock market. While this guide is primarily focused on the stock ETFs, which provide more opportunities for growth in your portfolio, we'll also cover two bond or fixed income options that provide a steady income but less room for growth. The first of which is the Total Bond Market ETF, or ticker symbol BND, which invests in high-quality investment-grade bonds in the United States. The annual return on the Vanguard Total Bond Market Index has been around 3.6% over the last 10 years. The fund invests in higher quality bonds with an average duration of 6 years and an average effective maturity of 8.4 years. What this means is that if interest rates continue to rise, it's likely that you'll see the price of the portfolio fall. However, you'll then be able to reinvest dividends at a higher yield going forward. Just note that there is some interest rate risk with BND. I should also note that the current yield on BND is 3.12%. If you'd like to avoid interest rate risk entirely with your bond portion of the portfolio, you could park your cash in the Vanguard Prime Money Market Fund. Now, this is a mutual fund, so you won't be able to purchase it on Robinhood, but you can invest it directly with Vanguard. It will cost about $3,000 for your first minimum investment. Well, this isn't a bank account, it's a money market account. The aim is to keep this fund's value at $1 per share. Never in Vanguard's history have their money markets broken the buck or dropped below $1. They've always been able to manage that $1 per share through conservative investment and risk management. Currently, the Vanguard Prime Money Market Fund yields 2.03%, or about 1% less than the Vanguard Total Bond Index. Personally, for me, this is where I'm keeping the majority of my fixed income portion because I don't like the added interest rate risk that I get for the Total Bond Market Index for only 1% more of an additional yield. Whether you decide to use the Vanguard Prime Money Market Index, the Vanguard Total Bond Market Index, or instead of using those, paying down debt as your fixed income portion of your portfolio is up for you to decide. Finally, here are just some very simple portfolios that you can easily implement when you're doing index investing. And you can adjust these however you'd like, but these can be a good starting point for thinking about how to construct a portfolio. So the first is just a very simple 50-50 split between the total stock market index and the total US bond index. So 50% VTI and 50% BND. This can be a good spot to start for new investors because you're not taking on too much risk by having a 90% or 100% stock portfolio, and it'll give you some chance to adjust as you see fit. For instance, in the second portfolio, which is a 60-40 split, I've replaced the bond market index with the Vanguard Prime Money Market Fund because I don't want to take the extra interest rate risk on the bond portion of my portfolio. Another popular portfolio is what's called the 3-fund lazy portfolio, which is effectively 50% the US total stock market index, a 25% for the international stock index, and then the remaining 25% for US bonds. Historically, in the long run, all of these portfolios have done quite well for investors who are able to stick with it and rebalance their portfolios over time. If you found this video helpful, leaving a like helps support the channel and I really appreciate it. Let me know in the comments if you have any questions and I'll be there to answer them. If not, what would your ideal index portfolio look like? Thanks for watching, and I'll see you guys tomorrow.
I like to